The Australian market is back near highs while the US has trailed, although both markets are showing signs of fatigue after the recent rallies. Gary Glover is assessing gold, lithium, uranium and energy stocks while looking at this week's top trading shares. He's also put in a history lesson for us covering the interest rate hikes, the impacts they have on markets, as well as the presidential cycle and Gann cycles impacting the markets at the same time. It's a lot to cover, but you've done your work. How are you this morning, Gary?
Yeah, I'm great. Yeah, sounds like we're covering the whole gamut, doesn't
it? It does. I'm pretty excited about the rate hikes that there's charts that you've dug up at the later part of what we'll cover. So that's pretty exciting. And I no doubt most listeners want to see the stocks that you've picked this week for trading. Before we do that and pull apart some of those commodities that you've highlighted, can you describe the overall picture that we're seeing in the market? So NASDAQ looks like it's still a long way off its high, and last night shows that it's really ramping up that bear phase. So what's standing out to you on that NASDAQ chart at the moment?
Oh, I just think this is a sort of typical sort of bear market rally, which was sort of seen plenty of in the past, and they're normally sort of short and sharp. Volumes are lighter, as we've seen, and then obviously reversed pretty hard here. So for me, there was some really key timing there as well. So I think we're roughly sort of 3 months, 90 days from a lot of the highs there, which is sort of one, what I normally sort of see that as a basing sort of pattern. So if we've got a low there, if we sort of find a high low 3 months there, it's not normally a good basing pattern. And then it's also the vice versa on the topping pattern as well. We can get a nice lower high exactly 3 months from the high as well. So just sort of something that I seen over and over again historically, and so that looks pretty negative. Just price action. I mean, we've really got the trend has tipped over, so that's really, what I mean by tipping over is we've had the largest correction of that entire sort of uptrend. So it's bigger than most of the other corrections before that. So just that size, basically, sort of, that's basically what we call an overbalance. So when we get an overbalance there, so sometimes you can go back and retest the high or a lower high. But, in a typical bearish phase there, you're just looking for, kind of a few sharp bear market rallies there and bring us down here. So being a midterm year, really sort of from, July, October are probably the two most likely lows there. So I think we might see a sell-off into the July, maybe some sort of bounce, maybe either a high low or maybe a marginal new low in October. Definitely a lot of October lows in the sort of at least second years. So that's definitely to be mindful. But yeah, I mean, I just looking at the chart there. If we measure that first leg down and then project that off the lower high here, that gives us a target around 11,000. Just what we call a classic sort of ABC, just a measured move. That's it, bingo. But oftentimes this, the C leg down, and that can be a bit larger as well. So I've always sort of felt like there's a good chance it'll come back to that 2020 high. I just think a lot of the indices they'll be drawn back there. So so I think it's a fair move back there. So I just think that's where I think it'll come.
That's a good outlook, or not a good outlook, terrible, but a good roadmap to work with the NASDAQ. And I'll quickly give credit to your portfolio that we've skipped up here. You've loaded up with the SNAS and the BBUS in the last week or so, just last 2 weeks. So no doubt with the market tanking, that's been working out well for you, has it?
Yeah, look, to be honest, I wish I'd got more, actually. I really wanted to get to, say, 10% of each, so get a 20% position on. So I was looking for a little bit of hoping for a little, just bear market rallies. They're normally sort of short and sharp along the way here. So just looking to add to that posse. So look, I think it looks pretty good here. I think we're gonna, see some big gains in here. But if I see any sort of rally in there, I'll probably add to it actually. I still think I can build on that position. I still think this is just going to be a big winner here for the next 3 months. I just can't see any other outcome there. I think all the conditions are just perfect for a nice bearish phase here.
Well, that's probably a good point to take us over to the S&P chart that you've brought up here. You've got a box and a circle. They seem a bit self-explanatory, but your analysis can be quite in-depth. So what do the box and circle mean on that chart?
Yeah, so again, just projecting that, the A leg down. and we've had a little sharp, B-wave rally, which is very normal in bearish markets. And then, so if we're just looking for a classic ABC, which is sort of what I call a standard correction, that would be so basically it gives us a target just below 4,000 there. I don't think this is going to be just a standard correction. That's probably the most common one here. I think it's going to be a little deeper here. I think, again, we've overbalanced the trend. We've got a tightening phase coming. We just, we've got geopolitical issues, supply chains, inflation. We've got it all going on here. So I think once this market starts to roll off here, I think the market will get a little scared. I actually think, Chris, that the downside here is going to surprise a lot of people, what we might get in the next quarter here. So it'll just be interesting to sort of see how this unfolds here over the next few weeks. But I still think this is going to be kind of running into at least sort of June, July here at the minimum.
Okay, so it's still a fair extension of time to get us down there. And as you're saying, there's a fair bit that it can do. It can come back that ABC length, or it could actually come back down to these horizontal lines that you've marked on the map, which is the old 2020 highs before we had COVID impacting the markets.
That's right. I just think that's a magnet there. That the old high is going to be a magnet. It's just, that's how trends sort of, So so we got our classic most common correction there is around 4, but I still think that something around 3, 4, 3, 5 probably, that's where I think it'll probably end up here. So,
right. Well, that's the circle, isn't it?
Yeah. So I left it open there. So I'm just trying to be modest. But we'll see how we go.
Okay. So that brings us to the parallel of the Australian market. It's been holding up relatively stronger. And you've got a rectangle here. So could this be echoing moves back to the year 2000? Is that what you're drawing on here?
Yeah, look, the strength, once the NASDAQ topped, and it's just so many similarities to that 2000, 2002 period there. So NASDAQ boom, obviously, broke in March. We had the tightening phase start to, interest rates starting to head up around there as well. I think the first one might have been Feb, and I think the second one was in May. By the second one, market never recovered. That was the bear market was in full steam. But at the same time here, the Aussie market kept bouncing back really strong. And actually, while the US market was getting decimated, the Aussie market actually bounced even to, a new marginal high at some point. So, maybe we might, we're pretty close to the high here. So maybe we can do the same thing, bounce to a marginal new high like we did in 2000. That's definitely possible. But we really had a big sideways sort of period through that market. And actually what we saw there was marginal new high, marginal new low, marginal new high, marginal new low. So the whole thing actually broadened. Yeah, that's it. Yeah, so broadened out like that. So really, really volatile period. So we could see that. I still favour this being a second lower high here. So I still think, I just saw a little bit of timing here. Again, we've sort of gone 3 months sort of from that, I think, at higher low there. So, I think the actual high to the low was 144 days. And I think we've gone high to high 90 days. There's a few nice cycles sort of running through there. So it just tells me, and the volumes there, look at the volumes the last 3 weeks there, Chris. That's been just heaps lower. So really we're so much less commitment in this last leg here. That's a bit of a concern here, because that's showing us there's no real strength in this rally. And you've noticed here the volumes are light. Just look at the banks where they are. The banks are trading on these massive multiples, probably multiples I haven't traded on for 15 years. And the volumes are low. To me, who's paying these multiples on the banks at the moment up here? It's just maybe flight to safety, or I don't know what it is, but yeah, they are on some incredibly high multiples there. And I know there's obviously things happening with rates and stuff and bond yields and stuff out there, but yeah, there's much simpler businesses now than there used to be. Less growth in there, and trading on multiples way beyond where they should be. So I think there's definitely risk. And obviously the commodities have been on fire as well. So there's definitely sort of room for a bit of a pullback in our market, but just definitely seen that the volume the last 3 weeks and just starting to get a bit tired here under the lower high here. So just be watching this. If we see any sort of weakness here and bearish reversal, I think if we take out last week's low, I'll view that as being pretty bearish. So I think we could see a pretty decent down leg here as well, back down to retest that low.
Okay, so that's an interesting aspect. We've got the banks running hot on high multiples, but at the same time, you've mentioned commodities there. So if we look back through the history books, those who've been trading markets for a while will probably remember the GFC. The Australian market topped out in 2007, but we had the miners still powering through. BHP came up to 50 in the pre-adjustment numbers before turning down. Could it be that the miners and the strength in commodities we're seeing at the moment is part of Australia's relative strength against the globe?
Oh, 100%. Yeah, I think in the past there was sort of more the I think some of the the banks and stuff were coming off sort of probably lower multiples financials and stuff there. So they, and the industrials were sort of coming off lower. So there was a sort of flight to safety in those previous periods. But yeah, this period here, it's the commodities have been on fire here. And it's definitely been bit rotative as well. You're sort of seeing, all stocks are on fire, then lithium is on fire. And so it's just definitely been coal stocks. So yeah, it's sort of been, but, we've seen this, for a while here now that these commodities go hot for a while, then they can really cool off pretty quickly as well. We saw it in iron ore, go berserk, then the whole thing just collapsed almost. And then it's gone crazy again, so just have a look at the lumber price, things like you've seen some of those charts are up and down. So just got to be cautious with the commodities because they can really, they tend to overheat and then they get overcooked on the downside as well. So they'll correct pretty quickly once they're done here. So I think there's a blind faith here that commodities are going to stay hot for a while here, considering what's happening around the globe here. But, if there's any concerns about a recession coming, and a slowdown, that's going to affect commodities. So, just got to be a little cautious. I just sort of see on that BHP, I got a little bit of timing there. I noticed that sort of it's gone sort of low to high there, sort of 72 weeks, and then we've just gone half of that back up to the peak here, gone pretty close to an old high. Again, that volume is sort of lightening off here as we're sort of getting higher. Volume's getting lighter and lighter here. So just come back to retest the old high after what I call that like an overbalance as well. That's a pretty big correction in the trend. So oftentimes when you see that, they can come back up and retest the high, So just interesting here. We've got a bit of timing here to watch out for. And so if we see any weakness and reversal here, again, if like the XJO there, if I saw price go to a new low, take out last week's low, I'd be concerned about what's happening there as well. So I'm not in the camp there that these commodities are just going to keep marching on. I think we've seen here in the last couple of, the last 12 to 18 months that they're a V-shaped proposition. They go up, V-shaped, they drop, sort of that sort of V as well. And it's just, so I think there'll be really volatile moves here. So just,
good trading opportunities.
Yep, definitely. But I'll be cautious here right now. Just got a bit of timing and, just a few other things are sort of telling us to be really, really careful right here.
Well, there's a couple of other commodities that you've got later in the report, but what we'll have a look at here is you've picked up some of these reopen trades. Now, reopen's been a bit long on the tooth now. It's had many rallies and pullbacks, but you've got Web in here. So what's catching your eye on Web?
Yeah, the reason I've highlighted Web here actually is what's happening with Air New Zealand. So if you remember here, then we saw this massive rights issue occur in April of 2020. And I think, Flight Centre and Qantas, as well as Webjet, they did all these rights issues. And I think usually within a few weeks of the low, that was pretty much the low. And the thing is that oftentimes the market gets wind of these things coming, and then you see the price weakness, and then these rights issues tend to occur oftentimes near the low. And we saw a blue scope one still years ago, just seeing so many of these big rights issues, just when there's obviously, having to raise capital because of, just the stress situation or something left field. But yeah, so I just think it's really interesting here. We just saw that rights issue done there for all those stocks, and I think they all had like 40-50% recoveries from their lows if you were able to sort of buy down there where the rights issue occurred. So just sort of an observation there in the past of just seeing this reoccur here. And I just noticed that Air New Zealand, which is 52% owned by the New Zealand government, so they didn't do a cap raising at the bottom of the panic. So when COVID sort of took hold in Feb, March, April 2020, what they did, the government actually lent them some money instead. Okay, so they avoided sort of raising equity at the lows here, but so the prices had a bit of a bounce, obviously, and it sort of weakened off again, and then obviously, the last sort of month or so here got wind of markets knowing that we're going to do some sort of raising here to sort of pay back that loan. But yeah, it's come in again. So basically what that means is, the shareholders at 130 got shares at 49 cents. So I think it averaged out around sort of 75, 80 cents or something like that, sort of where they'll be set here. But I'll always sort of generally try and look at market cap as a guide, sort of what, I think the market cap was previously sort of, I think it was like 3.85 billion when I was at the high there, and I think it was 2.43 billion when it was at the low there in the last 5 years. And then, so that's sort of where it normally sits. So now we're sort of, Air New Zealand has raised equity. It's now basically got its balance sheet nice and clean, and sort of set for the reopening here. And now we're at the lowest market cap it's been at as well. So for the last 5 years as well. So no, obviously a few more shares on issue. So you got to look at these. Sometimes this is why, Webjet and Flight Centre, we're never going to go back to those $40 marks because there's like twice as many shares on issue. But so Air New Zealand's are saying there's I think the bonus issue is 2 for 1. So there's a lot more. There's almost 3 times as many shares on issue now. But you can definitely sort of see it, going back to that sort of normal market cap there. The midpoint there would be probably around that 130 mark there, I think, which is, even a move to 105 there would represent, if you can get set around 70 cents, that's got you like a 40-50% move. So, so I think there's some upside potential in there. Maybe it can go a bit higher there and go back to the old market cap, but yeah, definitely some value there. I know people say it's a bit risky here, but these rights issues just got a habit of coming in at the lows. And I just think, that I'm a believer in the reopening. Just need to see the airports the last week here a bit under the pump. So obviously having teething issues there, reopening, but they're definitely showing that people want to travel again. So I just think that, the next sort of 12 to 18 months will be big for travel. So, yeah.
It's interesting you talk about the rights issues. I remember I've looked at some other studies presented by fund managers talking about exactly that in the history of markets, quite often the companies like BlueScope and Rio will do the rights issues and the capital raisings at the bottom, the worst part of the market. Yeah. They need to, and they're desperate.
I actually remember doing the BlueScope and the one still. I bought those just before the rights issue, and then got the rights issue. I thought, oh damn, and then over the next 6 months, or might have been the next 9 months, there they were the best performing in the portfolio. So just absolutely cracking returns after that. So so you end up with more shares than you really want, but you're forced to take them up at these discount prices. So you go overweight, but then you get if you can hang on here, oftentimes quite rewarded here. So I think it's a fair opportunity there for me.
Well, that's some good insights into this, because no doubt a lot of investors will be looking at that and scratching their heads.
Yeah.
So you've traded them many times before, but another thing you've traded a lot before is really hot sectors in the commodity space. And uranium and lithium have been two of the hottest. You picked up Paladin in this week's report as one trading share or a chart that you're analysing. So what is it about the Paladin uranium story that's catching your eye?
Well, I just sort of, I was originally sort of daily there, how it sort of consolidated there, and then just saw some big volumes as well, sort of starting to break up, past the previous highs there. So on the weekly there, we can sort of see we had big volume at the low, first couple of weeks off the low. And then we had a bit of a congestion there, low volume, and then we've had high volume again, and then close to a new high there. So I kind of call that, breaking above the little swing high there is a positive sign there. Breaking sort of outside of that sort of pennant as well. It's kind of positive, and just saw massive volume in some of the uranium stocks there. So you got Japan. Obviously, there's a lot of regions in the world that are relying on Russia for oil and things like that. So they're all talking about basically possibly converting to more nuclear energy. And so Paladin's obviously raised some money here, gonna reopen new mine there. Just obviously the big push there for alternative energy sources there. So so just looks pretty positive there.
You also picked up Banerman, which is in that same space. So yes, politically charged with uranium, but Banerman, that chart looks notably different. So that's a big gap up there. What does this tell you?
Oh, just the volume, Chris, is the one is really the eye-catching part there. So two big, massive days up in big volume there. We saw the volume dry up on the consolidation, decent volume off the lows as well. So just considering what's happening around the world, obviously, we're sort of shifting from commodity to commodity. I just think uranium and gold still looks pretty positive here. So I know the gold stocks have been still pretty buoyant. So those are probably the two sectors I sort of favour there. I think a lot of the other sort of commodities are looking pretty tight. We saw lithium drop pretty hard there last week. So I think the oil stocks are looking pretty vulnerable as well. So a few of those sectors looking vulnerable. I think uranium and gold still probably the two that I think that look still reasonably buoyant here. So
well, they're ones to trade and put on that trading short list. Now we move over to the history lesson. This is the critical part, because we're talking about a federal election in Australia, and that most likely there's not going to be an interest rate hike until June after it's announced, but that may set in a fair few consecutive interest rate hikes in Australia. And we've been warned in Australia in the Reserve Bank that we're actually behind the rest of the developed world in rising and increasing rates. So you've looked at some of these charts of what it means in the US for rising rates and how fast they are. Can you talk us through this chart you've got on screen?
Yeah, I mean, it's just interesting, Chris, because obviously, the viewers are probably seeing all different, commentators talking about, rates going higher and markets can still go up, and markets have gone up in the past. And it's just, it's just, I just sort of people will sort of say things without really studying the data. And so I'm sort of one who sort of definitely studied a lot of history. And so I know that when you've gone through a really low rates period there, and then particularly when markets are pretty hot, and then Fed decides to sort of lift rates, and that can sort of cool off markets for a bit. So ultimately, you're trying to cool down the economy, so it can still keep going up, but you're really trying to put the skids, trying to slow it down. So, but it's interesting here that Ned Davis have actually got to put out something there. Actually, only last week, I think it was, and but just looking at sort of from the first sort of rate hike, so whether there was sort of no tightening followed, or whether there was a sort of slow tightening cycle, or whether there was a fast tightening cycle. And there's a massive difference between the three. There's obviously saw whether, after a rate hike there, where there was sort of no tightening that followed there, obviously markets in green there were pretty robust. And this is, we're not talking about one or two periods here. We're talking about, quite a few periods here. And obviously the blue, so the black line there is our sort of slow tightening cycle. So obviously once we sort of, rates were sort of going higher, but obviously more at a modest sort of rate there. Obviously still positive, but obviously a little bit more measured than our no tightening phase. And then we've got our fast tightening phase where the Fed's really aggressively, put rates, move rates higher and stuff there. You can see that orange line there where we sort of cooled off there. We've gone back to retest the high, but then we've sort of consolidated here. So basically sort of gone sideways to, maybe slightly downward in that period there. And it's literally taken 2 years to get back above that high. So just tells you that a fast tightening cycle is not so great for equities. And I think there's a lot of you're looking at this is what 67, 73, 80, 87, 94, 99, 2004. So we're looking at a reasonable subset of examples there, but it does sort of it does sort of show that the difference between the phases there. So as just so we should have this, definitely should have some concerns here at the moment. Just to me, it does tell us here that at best here we're going to go sideways for a couple of years. So if the Fed's aggressively lifting rates here, it's going to be a bit of a negative for equities there, and it just you've got all the other headwinds going on as well at the moment. So so just a really interesting chart, just more of a fundamental chart, and that's sort of more aligned with with everything that I've sort of seen and studied in history. That tends to sort of match up with what I sort of in my sort of view there. But it's just interesting, people will push their agendas out there, but it's I just think Ned Davis has sort of covered it off pretty nicely there, just showing the difference there. So we can definitely go up here, but I think it's obviously in the fast tightening cycle, it's going to be harder to, it's going to be more measured. It's going to be a tougher climate ahead for equities.
So this fast tightening cycle here sort of resembles the yield curve that we're seeing in Australia at the moment is certainly pointing towards a fast tightening cycle, isn't it?
Yeah, and we're seeing once we go through corrective periods, I mean, it's just like a chart here. It's like an ABC. It's like a big sideways consolidation after a great run. So it's quite normal. So we've had a fantastic move into here, and then obviously so we're it's very telegraphed here that this is a fast tightening cycle. Inflation's actually is bringing this on a lot faster and harder than the Fed wanted, but they've got so they've indicated they've got no choice here, so they'll be tightening fast here. So look, maybe we might start off fast here, maybe they'll slow it down the second year, and maybe we'll get more of a the black line there. But let's say it just does suggest here that's probably we should be the gains are going to be harder to come by. It's no doubt about that in my mind.
Well, compared to the last decade, what you've got here between the slow tightening cycle and the fast tightening cycle, that's 12.5% over 2 years. So that's coming back to some more close version of normality, right?
Oh, look, if you went back 5 years ago and said, hey, we're going to have negative rates, people would have laughed at you. So what are you talking about? But so amazing low period of rates here for an extended period of time. So, and that's obviously fueled asset price and bubbles there, which is often what happens after central banks print a lot of money. So honestly, there's very little new that's happening here that's happened in the past. It's just people don't go back and actually study the past too well, or don't do it in much detail. So, so it's, when we've printed a lot of money in the past there, 9 times out of 10, we've generally got a lot of inflation there. And again, if we've got this sort of tightening phase as well, we know what's going to follow as well. So do your homework, folks. Look at the data. Go and study the past. When you're interviewing for a job, they basically question you to sort of see how you behaved in the past. That's the best way of working out how you're going to behave in the future. It's the same with equity markets.
Well, that's a good point to extend that history out a little bit further and have a look at the presidential cycle. So again, from Ned Davis, you're looking at the presidential cycle for 2022. What does this mean for the markets? What does this chart describe?
Yeah, so the 4-year presidential cycle there is it's the midterm year. So it's normally sort of you see a bit of strength into sort of that April sort of period, and that might be around mid-April there. It obviously varies sort of year on year. Then you see a bit of weakness into that sort of that June, sort of July period, and also oftentimes October is the deeper low. So this is kind of more of a, I think this might even be going back, I think they've gone back like 100 years here or something. So they've gone back pretty deep here. So it's a long measure. And I think Ned Davis here, I've just sort of overlaid it with the current market as well, sort of what they're, so I think if you look at the seasonal chart there, might look a little flatter than this. But yeah, I think it's just a good indication of sort of how this falls in. And if you look, Chris, I should have put this chart in as well. It's sort of hard there, but do yourself a favor and look at the 4 years. So look at the midterm year lows. So go and look at the XJO, or go and look at the Dow Jones, S&P there. But sort of from that, if you look at, say, June through to October period there, just draw a little line there, like do a 4-year cycle, and look at for the last 40, 50 years there. It's this midterm year is often referred to as the year of the bottom picker. So many of the lows come in that midterm year. It's like a magnet, or it's like a weight, it's like an anchor, bringing the market down. So the best 6 months of the year actually come out of the, usually from October, out of the midterm year. Those are the best 6 month returns as well. So I did a study there, going back in 2010, I think, for the Dow Jones. I think over the previous 20, 30 years there, it was, I think the average decline into the midterm year was around about 16 to 18%. And the average rally by the year end was 20%. So it was just get drawn down into these years and drawn out. But if you look at those sort of every 4 years, there's like a really, just look at the seasonal cycle. It's really gets sort of drawn into these sort of lows there. So they're often around that sort of, I sort of think June, October is sort of a little window there. I'll try and put them in action. I'll show you next week that charts. You'll be amazed how
these cycles work.
Yeah, just get drawn into these sort of years. So it's every 4 years there. So a bit like the 20-year cycle like we're going to show next is sort of similar, but in that, if you look at usually around October, every sort of 20 years, whereas the market gets sort of drawn into a pretty deep low. Can also be around that July period as well. A few of them, there's a few deep lows in July, but yeah, we've seen some really deep lows in 02, 82, 62, 42. It's just, and usually sort of around this April into that sort of period is sort of that's the sweet spot for the bears as well. So if you look at, that's when the majority of declines come. So we're approaching the riskiest segment of the year here in terms of seasonal, in terms of cycles, in terms of just looking at even the fundamental cycle there of the tightening phase. Everything's just telling me to be super cautious here right now. It's just everything's so bad. And I just sort of think we've had a cracking run. This market, such so much liquidity pumped in the system here, and once it all dries up here, I just think there could be a little bit. Just might, once it starts to sort of sell off here, I just think people could get a little bit scared here. I think you'll see things like, the riskiest segment, things like crypto and stuff there. I'll be horrified. I think by, I'm not sure it's going to be July or October there. It could be some people looking for jobs in that sector there by the time it's finished here. So I just think you're going to see some asset prices get ripped up here pretty hard in the next sort of 3 to 6 months. So, just going to be super cautious here, Chris. I think I'll be holding a bit more cash. I'd be a bit more hedged. I mean, time to be very cautious.
Well, it's history's indicating that caution. It's not just you looking at tea leaves. It's pulling apart, doing the research, understanding how the cycles have impacted. Yeah.
And, the good news is that there's some of those, once we do get like the midterm year lows, if you look how they often come pretty deep, but they do bounce back powerfully as well. That's the good news, is that they really can bounce back pretty quickly. So, so just got to get the timing right here this year. Just got to be, I think, a little bit defensive here for a while. Wait for this sort of deep, low here. I still think maybe July, have a nice bounce. Maybe come back, either make a marginal new low in October, or maybe a slightly higher low. Depends how panicky we get into that sort of June, July window. But I think it's all in front of us here. Just everything just seems to be matching up here. So it's almost sort of almost too matched up too well here. But I just think it's all the conditions are perfect for a bit of a correction here. So the next sort of 3 to 6 months here. Right.
Well, that's a good insight to take into this, especially if we're seeing a lot of red each morning when we wake up. So
Yeah, I mean, the US market looks pretty weak. I know our Aussie market, that's the positive, obviously, for our market is that we tend to outperform when these sort of when the US has gone through a bit of a growth crunch. Our market has held up so much better. So, there'll definitely be opportunities in the Aussie market, but yeah, you just got to be, still got to be a bit cautious here. I still think you'll see a little bit of weakness there.
Nice. Well, there are some good insights to take into this market. Thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.